Today's podcast is devoted to fighting that at-home bias. I'm Mariann with Thriving with Your Money Tree, and thank you for joining me. You know, there's always a choice for people, and you tell me which one you would prefer. A 20-foot blue spruce tree, common to the U.S., or a 200-foot Himalayan spruce tree. They can grow even taller than that. Would you prefer an apple tree or a pineapple cactus? Would you prefer a California poppy to a Hungarian blue poppy? Well, those choices do exist. And what I'm trying to tell you is that if you had to choose a garden or a portfolio of flowers and trees or other assets that are common to your area, or a garden that incorporates other offerings from other parts of the globe, which would you prefer? This podcast is devoted to teaching about at-home bias, or the concepts that investments in one's own country just appear to be more attractive than those outside of one's home country. Wherever you're from, we all have at-home bias. And that is, people in the US tend to buy US stocks and bonds from US-based companies, thinking that they know this market best. People in the UK tend to buy stocks and bonds from companies in the UK, thinking they know the market best. People in France, people in China tend to buy stocks from their own local companies. And it's so on and so on around the world. So you should take some notes. Do you have your notebook ready and your pen? I'm giving you time to write this down or set up a word and type in your notes. Now, early in my career, I worked for a Michigan-based brokerage firm doing research analysis on companies that were based in Michigan. And why did we do research only on Michigan-based companies? Well, the partners in the firm believed we would have an edge with existing and potential clients who preferred companies who were more interested in companies that were based close to home. And so we offered this offering of local company research. And that included auto part suppliers, since Michigan is a big auto part supplier. It included Michigan-based banks. It included Lazy Boy Chair Company and Woolahan Lumber Company, a retailer, along with Zondervan, the Bible publishing company. Interesting mix, all US-based companies, and believing that that would be most attractive to our clientele. Well, I wasn't really satisfied. I felt stifled by the lack of opportunities and started analyzing companies that were based in other states, still within the US, but other companies that based outside of Michigan that seemed to have opportunities, good growth, low valuations. And my recommendations were well received. And the clients did well as a result. 50% of the total market capitalization of all the companies in the world, all the publicly traded companies in the world, 50% are in the US. Now, in the European Union, Canada, and Japan, those companies' market values represent about 35% of the total global market value of all publicly traded stocks and bonds. And the emerging markets represent about 15%. These are all rough numbers, but close. And so if you had a buffet table set in front of you, would you limit yourself to just 50% of the items there? I wouldn't. Why would you limit yourself to 50% of anything? Now, where do we start when we want to invest overseas, outside of our own home base? When investors are considering U.S. stocks and bonds in companies that are based overseas, it's important to know the trend, the direction of the value of the dollar versus other currencies. Is the dollar getting stronger or is it getting weaker? Why is this important? Because the change in currencies directly affects the value of reported earnings in each company. Therefore, earnings growth affects the value of stocks and bonds, and the currency will be an important factor. So, how do we find the value of the dollar versus their other key trading partners? We use the ticker DXY, DXY, and you can find that on marketwatch.com or Bloomberg if you have a Bloomberg terminal. This compares the US dollar to a set of currencies that are our primary trading partners across the globe, primarily Europe. So again, that change in currencies will affect the reported earnings per share, and it's the earnings growth that determines the growth in the underlying stock price. So I've included a couple of charts here, and the first one is a 3-year trend in the US dollar versus those other currencies, the DXY. And you can see that for most of the time, the dollar was rising versus the other currencies. And then it started to fall beginning around October of 2022. And this is through August of 2023 when we're recording this. Next, I look at the trend in the DXY for the last 3 months. And here we saw that overall, it's been in decline. But there's a period starting about a month ago in which the dollar started to gain value. It had been hit for a while, and then it's come back, but the trend line is still negative. So if the trend is upward, it means the dollar is getting stronger versus other major currencies. If this is the case, then overseas investments are less attractive. If the value of the US dollar is going down versus other major currencies, you will see that in a line that is going down, and overseas investments are more attractive. So that's my starting point on overseas investing. Next, you can drill into the dollar versus specific currencies to look at those trends and choose which country or region has the best trend in their currency strengthening versus the US dollar. Note also where the central banks are raising or cutting their interest rates. Now, if the country is raising, the central banks of a country are raising interest rates, maybe they have to do it to fight inflation. If they're raising interest rates, then the value of their stocks are going down. And if rates are rising, it's a negative sign for that country's company's stock prices. But if that country's interest rates are falling, on the other hand, they're cutting interest rates in that region or that country, that's very good for stock valuations. It's a positive sign for that country's stock prices. Google this, you'll find it. Next, take a look at the valuations or price to earnings ratios of European, UK, emerging markets, and Japanese stocks by referring to the charts produced by Yardeni Research each week. Now, Yardeni is spelled Yardeni. They have a lot of research out there. They're very well respected. But I'm going to share the link to get more specific to the valuations by region, and that is by going to www.yardeni.com/pub/MSCIPE.pdf. Now, look at the first chart in that report, and each line is colored to represent a different region. And as you look at this chart, you will see that currently the lowest valuation, so they look cheap, are the UK stocks. Now, if you look back over time, look at that green line going back, and you'll see that they're usually the cheapest stocks. So that doesn't scream a buy to me. It's just kind of the way it is. Next, look at the region that has the highest line, the highest valuations, and that is the US stock market. Now, that's represented by the S&P 500 stocks. And if you want to know why they're at such a high level these days, Google that. You can find out the reason behind I'll tell you the secret. There's about 8 or 9 high growth stocks that have done exceptionally well, and they're driving that higher, while the other 490 stocks in the S&P 500 have not performed well at all this year. So let's get back to the different lines there. Look at each of those colored lines and look at the trend. Look how it compares to other countries over the years. This is going back to 2005. And you determine which one or couple hold the greatest of interest for you. So it's another screening process. Then look to see what the smart money is doing. And by smart money, I mean institutional investors. And each week, Morgan Stanley publishes a funds flow report that looks at US exchange traded funds versus those of Europe, of emerging markets, and Japanese stocks. So look to see where the smart money is going and where it's leaving. You can Google that too. Next, drill down into which sectors are performing best in your selected market. And you could even look at individual stocks here. But you can screen for companies in each region. You could simply go out to Bing or Google and type in your choice of country, your choice of sector. There's 11 different sectors, but say we're talking about materials. So, like Brazilian materials producer, leading market share, growing volume ahead of expectations, something like that, and see what you find. It will lead you to a specific subsector of that material sector, and probably individual companies. So, further screening. Look at FinViz, FINVIZ.com. And this has various drop-down menus where you can screen companies by region, by market size. Maybe you want to be in safer large cap stocks. Maybe you want to take on more risk and be in smaller cap stocks. It will show you those that have strong growing sales numbers and strong growing earnings, and those that trade with advanced depository receipts, or ADRs. This means that you can easily trade these stocks in the US markets on a day-to-day basis. Now, alternatively, you could look at exchange traded funds, or ETFs. Now, you can break this down by regions, like emerging markets, or particular countries, like Indonesia or India, Brazil. If you believe the industry is going to grow very quickly, you want to be probably in the high momentum or high volatility type of ETFs. For the emerging markets, it would be EEMO, those that have momentum. It has in that ETF about 200 different companies, so you have good diversification there. And then alternatively, if you think growth is going to be a little more subdued, good growth, but subdued, then I would go for the EELV, which is emerging markets, low volatility names. And they would probably contain things like industrials and financials, healthcare too. You could look by size. You can look for an exchange-traded fund that has a larger cap, and they probably have extensive operations already, or those companies that have a smaller sales base, a smaller footprint, but more room to grow. So the source I would use for that is Exchange Traded Funds Database, which is etfdb.com, and sort by the various things that you can screen for. Now, here's an example of size is FEZ, Frank Edward Zebra, which is a ticker for the Spider Eurostax 50 largest companies in the European Union. And alternatively, on the other end of the spectrum, India's small cap companies are in the iShares India Small Cap ETF, and that ticker is SMI, like Sam, Mary, ice cream. Yep. So by growth or value style, again, you could go into something like a technology fund based for companies based in China. That's the Invesco China Technology ETF. The ticker is C like China, QQQ. But firms that are already profitable, value type names headquartered in India, are in the Wisdom Tree India Earnings Fund, and the ticker is EPI, Edward Paul Ice Cream. Now, these are general guidelines and ideas that you should take into consideration for your total portfolio. And you can maybe get a head start with this if you narrow things down a bit and then go to your 401k choices if you have a 401k. And in that 20 or 30 different list of mutual funds that your company makes available to you, you'll probably find something that's overseas. You might find something that's specific to emerging markets or the European markets or a Japanese fund. If as you're looking at the equities that are broken down that way, also look at the bond side of things. You may find a mutual fund offering from your list of 401ks possibilities that involves overseas bonds. So once you've made a decision where you want to be globally, that may be a good way to get involved quickly. Otherwise, I've given you a number of resources you can use to try to drill it down on your own and have that other choice in your portfolio. So just remember that while most of your fellow U.S. investors may be gravitating to U.S. stocks and bonds, those overseas investors are gravitating to their local choices. So you will not be alone. Just remember too, there's a big buffet table of offerings out there, and I, for one, just want to have my pick of all of them. Thank you for your time.